All right, now, so moving on to our next conversation, we see investors are facing the triple whammy of geopolitical conflict with Russia and Ukraine, persistent inflation, and rising interest rates. How would all of these shape individual and institutional investors? Joining us right now is Ayodeji Ebo, Head Retail Investment, Chapel Hill Denham. Great to have you on the program. Good morning.
Good morning. Thanks for having me, Ladi.
Yeah, so, with the recent, ups and downs, in global markets, how do you think this will shape investors' sentiment in 2022?
Okay, thank you. Good question. And I think I would like to just classify the investors into two. We have the savvy, which I'll call experienced investor, that have seen these ups and downs in the market, and it's really no new to them. So in terms of their reaction to the market, will be totally different from those that are new to the market. So for those that are very experienced, and how I feel it will shape their sentiment is that it's always it's always good to keep calm when market is volatile. You need to take your time, because it's proving over time that market will always rebound. If you look at the analysis, you look at the S&P 500 in the last 50 years, market will always surpass its last high. So for the savvy investors, they would have been used to that. They see these ups and downs as opportunity to dollar cost average. And for the new investors, what I would advise is you should keep calm during this period of volatility. This is the time to get into good stocks and own them for long-term investing. Trading is always very tough during this time, and it's good not to trade, not to be active during this period. Looking at long-term investing is what I would recommend for any investor within this period, so that you acquire stocks that we've seen stocks that have been beaten by over 50–60%, and when you check their financials, they are still very strong, and they still have potential for growth. So by and large, sentiment will be negative, but it's always good to stay calm during periods of volatility.
Yeah, not easy, staying calm, with wild swings, in the equities market, and we're seeing commodities soar to new highs. But what classes of assets do you think, investors should be looking at this time?
Okay, thanks. And I'll believe that for the domestic investors, what I would recommend is their portfolio should be 50% in Naira and 50% in dollar-denominated assets at this point in time. And for the 50% in Naira, I would recommend for the conservative investor to have about 30% of that in fixed income, and have about the balance of 20% in stocks with high dividend yield. So you can set a base of above any stock that can give you 8% and above dividend yield. You can buy into them. And coming to the dollar side, you can also, I would recommend 20% of that 50% to go into dollar mutual funds. And if you have the capacity to buy euro bonds, there are a lot of African euro bonds that are trading at very attractive rates. You can take them. For instance, you see, yes, it may look high risk. The Ghana, for instance, you see some trading at 16–18% yield. And we believe that the prices would, once prices normalize, prices would rise. And the other 30%, we've seen for foreign stocks, a lot of those stocks, like I said earlier, have been down by close to 60–70%, but there are still a lot of potential for them. You look at the likes of those that are into electric vehicles. We know with the current geopolitical tension and crisis in Ukraine, we know that a lot of the Euro countries are also even the US are trying to reduce their dependence on fossil fuel. And it means that there will be focus on renewables. So those stocks will present opportunities as we go along. We also know that stocks were beaten this year as a result of expectation of Fed hike. We saw that 25 basis point increase this week. The Bank of England also increased yesterday to 0.75. So that has caused a major decline in some of these stocks, and this is the time that they can also position. It's safer to buy when prices are really very low and have potential for growth.
And, the battle, against inflation raises on. We're seeing central bankers raising rates globally. How do you think investors can actually protect, their investment against the impact of inflation?
Okay, thanks. This is a very interesting question. And the first thing I always like to say as a finance coach is that doing nothing will make you worse. So if you cannot beat inflation, try to bridge the impact. So if depending on your risk appetite, for very conservative investors, yields may be low in treasury bills. You have alternatives like commercial paper that offers higher rates. And when you do those calculations, discussing with investors, it may not be very encouraging. But once you understand that if you don't do anything, you leave your savings in your account earning 0%, inflation will make you worse off. So when you imagine the last inflation rate of February 15.7%, if you just do the analysis, it means if you have saved 1 million in the last 1 year, that would have declined by about 157,000 naira. So if you are able to invest in safe investment like treasury bills at about 4%, or you go to commercial paper, they're also very safe at 8-9%, some as high as 13%, then you are able to bridge a gap. So it's the mentality now is to see how do you want to reduce the impact. And for those that can take a lot or tolerate a lot of risk, this is also the time to get exposed to a lot of foreign stocks. You look at the S&P in the last 10 years, the average return is about 17.7%. That's dollar return. So beyond the adjustment that we make, when you say adjustment in Naira, it means you are up in Naira terms. So I believe that there are opportunities that are less risky, that you have control over, that you can put in your fund. So mentality would have to change, and you need to know that inflation is real and will impact on your savings and investment if nothing is done.
Yeah, inflation, very, very real. But, a report showed that Ponzi schemes are prominent, in a period of low interest rates and high inflation. How can investors avoid being scammed, at these times?
Okay, thanks. You are very right that the Ponzi schemers, this is the time they take advantage of investor psychology, because some investors would look at it investing in 90-day treasury bills at 1.3%. They won't try that, and they would look for other alternatives. But the best way so that you don't lose your hard-earned savings or hard-earned income is for you to be very mindful and ask questions. First thing is that you would see about Ponzi scheme is they give you guaranteed return, and it's out of. We just spoke about the average yields for fixed income. When you even look at bonds, the highest you get for long-term bonds is about 13%, 14%. So when you begin to see rates that are significantly higher than that and is guaranteed, then you should ask a lot of questions. And if you have to do it, just put what you know you can afford to lose. Secondly, most of the Ponzi schemes are unregistered. You have the SEC website where you can confirm companies that are registered with the Securities and Exchange Commission. You can also confirm with the CBN. So you need to also consider that. Thirdly, you would see that for most schemes, they will want you to bring in people before you can be able to reap significant return. So that also shows that they are trying to take funds. It's robbing Peter to pay Paul, trying to take funds from new investors and to pay old investors. So, and lastly, you should also see when their business model is very complex. When someone is trying to explain to you how they make money and you can't understand it within 5 minutes, then you should run, or you should limit your risk. So once you take this into consideration and you take greed out of it, and you remember you can lose all. So if you have to do it at all, put what you feel you can and what you feel you can lose. But it's always good when you look at period of low interest rate don't last for long. You can try to weather the storm and wait, and you would also always see that interest rate would also go on the high side within a short period.
So if I don't understand it in 5 minutes, I run away, and most of these new investing options take longer than 5 minutes to actually understand. But this is a time of they call it the year of the squeeze, rising prices. What's your outlook for inflation in the next few months, and how should investors actually position at this point?
Okay, thanks. It's not looking pretty good when we look at with the hike in global oil prices beyond fuel, which is a PMS that is deregulated, Other fuels are not. The diesel, the gas are not, and the cost of production have increased, which has also impacted on cost of transportation. All this would impact on cost of goods. And you also want to look at the major downside. You also look at the expected hike in electricity tariff. That would also impact on the cost of production. So we believe that inflation rate will continue to increase. There's also that food inflation because of insecurity that we would see, and also the impact of exchange rate on imported food. So by and large, it means that investors need to position. So if you need to increase your risk appetite. So when I say increasing your risk appetite, it means that trying to take a bit of risk in investment. So when you look at, for instance, some may be so comfortable with treasury bills, which is around 4.1%. That's government issued. But in period of low interest rate environment, corporates take that advantage to issue commercial paper for them to be able to, which is cheaper compared to when they take loans from the bank. It's good to take advantage of that. And I will always say, for commercial paper, don't also be carried away by high interest alone. They all have ratings, and you can spread your risk. Diversification is one of the good and very good strategy in investing. You diversify. Even if you see that it's very high, you can reduce the limits that you put into it. So that will help you to reduce the impact of inflation on your investment, because we believe that inflation will still remain on the upside, given a lot of the downside risk.
Right, every investor looking for that sweet hedge against inflation at this point. Edejebo, Head Retail Investment, Chapel Hill, Dan. I'm always great to have you on the program. Thank you for coming on.
My pleasure. Thanks for having me.
Okay.